Hi, we are Group 1 and we have chosen to analyze the IT services industry. So, the IT service industry is a global powerhouse that provides technology based solutions to businesses. This includes everything from developing software for financial analysis.
So now let's talk about market share product mix or service segments and the key geographic served. So basically to slower growth or less global branding compared to TCS or Infosys. Now Wipro. Now talking about persistent systems. Persistent has a higher
Hi, we are Group 1 and we have chosen to analyze the IT services industry. So, the IT service industry is a global powerhouse that provides technology based solutions to businesses. This includes everything from developing software to managing cloud infrastructure and ensuring cybersecurity. It's a massive and growing market that is valued at approximately $1.54 trillion in 2024, with a projected annual growth rate CAGR of around 9.4% to 2030. This rapid expansion is fueled by several key trends. Digital services sector for two key reasons. Hi, we are Group 1 and we have chosen to analyze the IT services industry. Hi, we are Group 1 and we have chosen to analyze the IT services industry. So, the IT service industry is a global powerhouse that provides technology based solutions to businesses. This includes everything from developing software to managing cloud infrastructure and ensuring cybersecurity. It's a massive and growing market that is valued at approximately $1.54 trillion in 2024, with a projected annual growth rate CAGR of around 9.4% to 2030. This rapid expansion is fueled by several key trends. Digital transformation. Companies across all sectors are modernizing their operations, shifting away from outdated systems to more efficient and cloud based technologies. Secondly, the rise of AI. The adoption of artificial intelligence and machine learning is creating huge demand for services that help businesses implement, manage, and scale these new technologies. Cybersecurity. With increase in digital threats, security has become a top priority for businesses, making cybersecurity services a major growth driver. However, the industry also faces challenges, including an intense talent war for skilled professionals and the pressure to innovate constantly to stay ahead of the innovation curve. For two key reasons. The first one is high relevance. IT services are the backbone of the modern economy, and understanding this industry is crucial because its health and growth directly reflect the pace of digital transformation worldwide. And secondly, the dynamic nature. This industry is constantly evolving with new technologies like AI and cloud computing, which makes it an exciting and relevant area for financial analysis.
So now let's talk about market share product mix or service segments and the key geographic served. So basically to calculate the market share for each company, we have used the standard method here. So we first took the annual sales for all the IT service sector companies listed in this data. Then we divided each company's individual sales by the total to get their market share. Now talking about each company individually. Firstly, TCS. TCS has the highest share both in revenue, that is the market share, and valuation, that is the market cap. Its market cap is higher than its market share, which means that investors value TCS more highly compared to its actual revenue base. So, this premium is basically due to its strong brand reputation, diversified service portfolio, and presence across global geographies. Secondly, talking about Infosys. Infosys has the second largest position. Its market cap is slightly lower than its market share, indicating the market value is fairly but not at a premium like TCS. So they have basically focused heavily on digital transformation, AI, and consulting. Therefore, Infosys is reliable but perceived as less dominant compared to TCS. Then talking about HCL Technologies. HCL's market cap is much lower than its market share, suggesting investors undervalue it compared to revenue contribution. So, despite their good business, automation, and engineering services, it may lack investor confidence due to slower growth or less global branding compared to TCS or Infosys. Now, Wipro. Wipro is significantly undervalued as its market cap is well below its market share. Though a global player with strong capabilities in cloud, AI, and cybersecurity, but yet weaker execution may have affected investor sentiment. Now, LTI Mindtree. LTI Mindtree's market cap is slightly higher than its market share, showing investors have confidence in its growth potential despite smaller size. So, they are basically known for digital engineering and cloud platforms with strong US and European presence. Now talking about Tech Mahindra. Tech Mahindra is undervalued. Its market cap is lower than market share. So despite strong capabilities in telecom, 5G, AI and blockchain, the undervaluation may reflect sluggish financial growth or weaker margins. Now talking about Persistent Systems. Persistent has a higher market cap than market share, meaning investors believe in its growth trajectory though small in revenue terms, but it is highly valued due to niche focus in product engineering, AI, automation, and healthcare software. Now talking about historical growth profit, that is EPS CAGR. So this is basically a simple way of saying how much a company's profit per share has grown on average each year. So basically here we looked at the profits over a few years and calculated the average yearly growth rate. A higher percentage means the company's profits have been growing faster. So some of the key strategies and initiatives here were that this includes mainly focusing on new technologies like AI and cybersecurity and improving how they deliver services to clients. Their future growth drivers and some of the risks include which points tell us what will the company think or how will they grow in the future, like the increasing need for digital services and what could be a problem for them, like a slow growth rate or a very high price for the stock. Now, talking about the growth outlook for the IT industry, which is very strong both globally and in India. The global IT service market is projected to reach $1.5 trillion in 2025. This basically represents a compound annual growth rate of 9.3% to 9.6% from 2022 to 2025, driven by several key factors. So, the sustained growth is primarily fueled by a global shift towards digital transformation, increased adoption of cloud computing, greater AI interaction, and the rising importance of cybersecurity. Looking ahead, the global IT services market will continue to expand rapidly, which would be supported by the demand from emerging technologies like electric vehicles, data centers, and smart grids. So by 2030, the biggest growth drivers are expected to be AI, cloud digitalization, and cybersecurity, which will help drive long term leadership. Indian IT firms are expected to ride this wave of growth by diversifying beyond North America, reskilling their talent, and adopting scaling automation and hybrid delivery models to basically boost their profit margins. Similar to the global trend, the slide indicates that by 2030, the biggest growth drivers for India will be IP led services, ESG initiatives, and cybersecurity. So, these factors are anticipated to drive long term leadership and sustainable growth for the Indian IT industry. Now, let's take a look at the cost analysis. Employee compensation and technology or cloud infrastructure are the two biggest cost centers for the company, collectively accounting for more than 50% of the total operating expenses. So, the other significant cost includes delivery expenses such as the travel and on site support, subcontracting, and general and administrative cost, which basically includes the sales, marketing, and business development. So here we can see that the company is actively working to optimize these expenses, particularly by shifting more to a hybrid delivery model and leveraging automation to improve cost efficiency and margins.
Now, let's move to the operational efficiency metrics and why these metrics are important. First, EV by revenue. It shows how much the market values a company revenue. A high EV by revenue multiple, like that of that we have a persistency systems, indicate that investors are willing to pay more for each rupee of sales. This is typically a sign that a market has high expectation for the company's future growth and the profit margins. Next, we have EV by employee. For the people-centric companies like IT services, this metric is a key indicator of workforce productivity and efficiency. It measures the total value of company in relation to its employee base. A higher EVA by employee, it values means the company is generating significant value for each person it's employed, which could be due to the more skilled workforce, high value contracts, or efficient use of automation and technology. It helps investor to understand if a company is getting the most out of its most important assets, which is the people. Now, let's move to the valuation metrics. Let's start with the price to book value, which compares the market price with the company's net assets. Companies like Persistent, which is 13x, and TCS, which is 18.8x, are trading at a premium, meaning that investor believe that they will keep creating value. On the other hand, Wipro, which is 3.2x, and Tech Mahindra, which is 5.4x, are much lower. It shows that the market is more cautious about their growth. Let's move to the price to sales ratio, which tells us how much investors are paying for each rupee of revenue. Again, Persistent is at a top level 6.6x, showing how high confidence in its future. While Tech Mahindra, which is at just 2.8x, it reflects lower growth expectation. And when we move to EV sales, which is the broader version, since it includes debt and cash, we can see the same pattern. Persistent is the most expensive, which is 6.5x, and Wipro stays the cheapest 2.9x. Now let's talk about the profitability base ratio, which is the EV by EBITDA and EV by EBIT. We notice that Persistent is trading way higher than, like, it's trading way higher, which means the market is paying a steep price for every rupee of profit, expecting strong future earnings. And on the flip side, Wipro and Tech Mahindra are much lower, which signals more conservative expectations. Finally, the most common metrics, which is P by E ratio, which is price to earning ratio. It tells us how much investors are paying for a 1 rupee of a profit. Same as Persistent is at 54x, the highest in the pack we clearly see, and it has also a future growth. TCS and Infosys are in 21 by and 22x range, which shows, like, steady leadership, while Wipro at 18x reflects more cautious outlook. So overall, we can say that like companies like Persistent and LIT Mindtree are priced like future star, and TCS and Infosys are valued at strong leaders, and Wipro and Tech Mahindra are treated as safer but at slower pace.
So now let's look at whether we should hold, buy, or sell these. Well, starting with TCS, its price to equity, price to earning is lower than the industry median, which looks fine, but growth is only average. The PEG ratio is around the median too, which means it's fairly valued. That's why we simply hold it. It's stable, but nothing extraordinary. Now, coming to Infosys, on the other hand, is more attractive. Its P is also below the median, growth is slightly better, and PEG is comfortably lower than peers. That makes us undervalued for the growth it offers. So, Infosys is a buy. Now, HCL Technologies looks risky. Its P is insanely high. That is 105.7x. It's more than triple the median, while growth is nothing special. The peg is way above the industry to which screams overvaluation. That's why we just hold it for now. No point of buying more. Wipro looks cheap at first glance, but its P is lower than the median. But the problem is growth. It's very weak, and the peg is still higher than the median, meaning the low price is justified by low performance. So again, we just hold it. Now moving to LTI Mindtree, here P is at the industry median, but growth is much stronger. The peg is well below the median, which shows you're getting more growth for the same price. That's why we say it's a clear buy. Now, Tech Mahindra is even more interesting. Its P is almost at the median, but growth is outstanding. Over 40%, far higher than everyone else. The PEG is less than 1, which means the stock is undervalued compared to its growth. That makes it the strongest buy in the pack. Finally, the persistent systems. This one's a red flag. The P is much higher than the median, but growth is weakest of all companies. The PEG is extremely high, showing it's overpriced. That's why the recommendation is to sell. You're paying too much for very little growth. So overall, we buy Infosys, LTI Mindtree, especially Tech Mahindra for their growth and fair value. We hold TCS, NHCL, and Wipro as they're stable but not exciting. And we sell persistent systems because it's overvalued and poor growth.
Now let's move to the charts of each companies. This is a chart of Infosys. It shows us like the blue line that we saw. It's like a day-to-day stock price. The light blue bars, it shows how many shares were traded in a day. uh, Bigger bars, that means more activity. The orange line, which is a 50-day average line, it is short-term trend of the stock. The gray line, which is a 200-day average, which is a long-term trend of the stock. Now, what is suggests that in October 2024 and to Jan 2025, the prices was high. It's around 1900 to 2000 and stayed above the average. That means stock was strong. But there was a turning point in Feb and April 2025. The price were dropped. In March, the orange line, which is a 50-day moving average line, went below the gray line to 200-day moving average line. uh, this is a death cross which signals a weakness. That means big volume showed panic selling. Then there's a downtrend in April to August 2025. Price kept falling to 1500 every time it tries to rise, but it hits the average and fell the back. So it clearly shows that there's a downtrend with a lower highs and a lower lows. The next we have HCLs. HCL, its uh, peak at in October 2024 to January 25. The stocks was strong, but there was a crash. Price dropped in between February to April 2025, and it dropped to below 1400. The orange line went below the gray line, which is also the death cross, which shows that stock turned weak. The next we have for Wipro. The Wipro was on bull run in October 24 to Feb 2025. Stock rose from 260 to 320 rupees. It shows the strength of the stock and the share price. But in February and April 2025, it collapsed. Price crashed to 240 rupees, and in April, the death cross appeared and start weak. There's a start of weakness here. Then we have LIT Mindtree. In this, the stock, after the beginning at a high point, the stock price fell sharply. Like as you can see, a key negative signal called that cross happened in February and confirming that there's a downtrend. And the bottom is in the April 2025. The stock hits its lowest point in April and the selling stopped, but it recovered. The stock began to climb, and it became steady in May. And most importantly, it has a positive signal called golden cross, which just happened in August. This is where the short term trend orange line crosses the above long term trend gray line. In TCS, the chart shows a stock that has been in a long and served downturn for the entire year with no real signs of recovery. There was an early warning signal in November 2024. There was major negative signal called death cross appeared in the last year, and this was an early sign that the stock was heading into a long-term downtrend. It continues. It like all over the year, the stock price has fallen steadily and all the year. The orange and the gray trend lines have acted like a ceiling, consistently pushing the price lower. Now let's move to the Tech Mahindra. It rise until April 2025, then start falling. and then it crashed hard and negative warnings in April. Then the stock, in May and to July 2025, the stock then made a surprise comeback, and this looked positive, but it was a bull trap. It tricked the investor into thinking that the stock was strong again, but it failed to hold its gain. And in August 2025 to till present, the recovery is failed. Like, and the price start falling again. The second death cross, the one death cross is in the April, and the second was in on the August. Now let's move to the persistent system. Until January 2025, the stock was doing great when its price climbed steadily to a peak of nearly 6,700. This was a healthy uptrend. Now, but in a February to May 2025, there was a sudden crash, and the stock then had a very sharp V-shaped crash, and this event was very volatile and broke the old stable uptrend. And after the crash, the stock moved sideways with a no clear direction. The stock, the most important recent event is the death crash in late August, where the short term trend crossed the long term gray line.
Okay, so now let's look at the recommendations whether we should hold, buy, or sell these. So, starting with TCS, its PE is lower than the industry median, which looks fine, but the growth
So good work, good job.